Welcome back. You're watching The Money Show on ET Now. Well, just before we went into the break, we were discussing tax planning and what are the instruments available out there for you to help cut down your tax bill for FY21. You did hear the word ELSS quite a bit. Sujit Bangar as well did give this particular product a thumbs up. So we decided to take that forward in our Meet Your Fund Manager segment and bring on board one of the best performing ELSS fund schemes in the last 3 years, which by the way is the lock-in period for ELSS. That is the DSP the DSP Tax Saver Fund. I have with me now Rohit Singhania, the co-head for equities with DSP Investment Managers, joining in on the show. Mr. Singhania, thank you so much for taking out time. So we know it's an ELSS fund, but tell us a bit more about it. Where does it invest? What's been the secret sauce for its double-digit returns in the last 3 years?
You look at the ELSS fund as a category, right? You can compare them like a flexi cap fund, by which there is no restrictions to have a certain allocation to a certain market cap. So whatever fund manager likes the stocks in whatever market cap they should be, he can invest on those stocks. That's one. As far as our DSP Tax Saver Fund is concerned, historically also, and as we stand today, we have had a bias towards large caps. So our large cap positioning has always been above 65%. It's nothing by construct or it's nothing a scientific reason to it, but that's how it's been. As we stand today also, we have a large cap weight of about 66%, mid cap about 22%, and small cap about 11%. Today, we are positive on financials. We expect that whole NPA cycle reversals, which has already started to continue, and hopefully credit growth will start picking up from the second half of next financial year. We also like materials, and materials is a combination of steel, cement, specialty chemicals, and building material companies. We also overweight on telecom and certain textile names. So that's how the construct is. Now, in terms of the secret sauce, I think I'm not aware if there's any secret sauce, but what I think worked well for us in terms of managing the fund over the years has been, before buying a company, it is very important to understand the business model, what the company is into, what are the dynamics working, what are they doing, what the competition is doing. Once you have a thorough understanding of the business, that's the first starting point. Then we start looking at, what can be the future prospects of the company, what are they doing in terms of capacity addition, what businesses they are, what the competition is doing, and what can the profitability be so. I know, it's very difficult to, predict future profit growth, but when you're buying a stock today, you're buying for its future earnings potential. You do look at the past in terms of how the businesses have performed, whether how cyclical it is or no, what the management has done. But in the end, the future earnings and the business drivers is going to drive stock prices. So that holds a key important point. Once you have analyzed the business model, and you're fine with the return ratios, etc., the most important thing is what price are you paying for buying that business? So my mantra has been, always have some margin of safety when you buy a stock. By margin of safety, I mean is, what are you paying today for that business? What do you think the business can be worth in the next 2, 3, 4 years' time? And what are you paying today? I think that's a key mantra for me. Lastly, keep on questioning your own assumptions. Things change, very often sometimes. So you should not be stuck to, what you decided while buying a stock. Have the assumptions changed? And if they have changed, do you need to take corrective action in a portfolio? I mean, it may be a big portion in a portfolio, but if the fundamentals which you had bought the stock for, you see them changing or deteriorating, you need to take corrective action. So I think this has worked well for me in terms of how I manage the fund. This is how it's going to be continue to be managed.
Okay. All right. Let's talk about ELSS itself, because this is a category that's competing with other tax-saving instruments as well. Where do you think ELSS scores above the other instruments?
I think, talking to an equity person, what actual benefit I feel of ELSS is, usually when we talk to prospective investors or clients, right? And when we talk about equity investments, we say at least be invested from 3, 5, 7-year period, right? And then in between you have volatilities and you see people, getting out of the market or getting in at wrong times. So by the sheer construct that it's a 3-year lock-in, it is giving that investor, is inculcating in the investor that time horizon. Okay, now I have put my money, whatever my view may be today, whatever near-term challenges maybe the economy is facing or the business is facing, I cannot remove my money. So it gives you the idea of being invested in equity over a longer term period and taking the compounding benefit of it. Because in the end, we all want, wealth to grow. So at times in equity, we always say, the time spent is more important than timing the market. I think ELSS by its construct makes that easy. Certain technical factors are there, in terms of the holding period. I think ELSS is one tax saving ground whereby, the holding period is just 3 years. It's, I think, the minimum amongst various options available. And also at the end of 3 years now, you just tag that 10% long-term capital gain. I think for me, these are the key benefits, which ELSS offers to investors.
Okay. The last few months we've been seeing net outflows from ELSS. Usually we start seeing net inflows from December onwards when people get into tax saving mode. What do you think explains that? And do you think this is the right approach as well? Why do you think people are redeeming their funds?
I think, if you see the last 3-4 months phenomena of redemptions, and not only on ELSS side, but other mutual fund schemes also, I think last year, calendar year 20, was not an easy year to digest, right? We began the year with first calendar year, you're almost seeing a Nifty fall of more than 35%. The calendar year ending with a Nifty growth of almost 17%. So the kind of volatility and swing which we saw, I think it's very difficult for one to digest. Two, as an investor, I think it's psychology, right? You're seeing your NAVs grow till a certain point and suddenly you see a 40-50% fall. You get scared. I think that psychology, which I think played in the investor's mind, whereby they saw, okay, the capital coming back, whatever losses they had witnessed in the first 4 months of last calendar year, they were now into profits, so they booked some profits out. Other reasons, which I don't have pure data to analyze, but when you look at the trading volumes in the market over the last 8-9 months, the participation of retail investors have gone up drastically. So it could be a reason, people seeing if everything's improving, markets have, improved, the vaccine is taking shape, maybe they're going directly into equities. So I would say, yes, what happened in the beginning of the calendar year, the volatility, I think that's what has driven, the redemptions.
Okay. Redemption to come by. All right. Okay. Well, Mr. Singhania, thank you so much for giving us a sneak peek into the DSP tax saver plan and just sharing your take with us on the overall concept of investing in equities also to save taxes. And with that, we'll take a very short break. Be right back with our Spend with TMS segment.